Hey, what's up, Money Warriors? Your girl here with some explosive news that's shaking up the healthcare world and hitting your wallets hard. We're talking about UnitedHealth Group, the absolute giant of American healthcare. For months, their stock has been spiraling, bleeding cash, and now, after their latest earnings report, things are looking even more brutal. If you own their stock, or if you're just trying to understand why your healthcare costs keep climbing, you need to hear this. Stick around because by the end of this video, I'm going to tell you the one crucial thing that could make or break United Health's comeback story and what that means for everyone on their health plans. All right, let's get right into it. United Health, ticker symbol UNH, just dropped their second quarter numbers for 2025, and they were a major headache. We're talking about a company that brings in hundreds of billions of dollars in revenue, but their profits just fell off a cliff. Seriously, their adjusted earnings per share came in at about $4, way below the approximately $4.50 Wall Street expected. And get this, their actual profit for the quarter was around $3.4 billion, which is down a big chunk from last year. But that's not even the worst of it. They also gave us a new peek into their future earnings for 2025, and it's a total downgrade. Back in January, they were hoping to make up to $30 per share for the year. Then in April, they cut that to about $26. Now, they're saying it'll be at least $16 per share. That's a massive drop, and it sent the stock tumbling. Their shares have lost over 40% of their value this year alone, hitting a 5-year low. It's now the worst performing stock in both the S&P 500 and the Dow 30. Other big insurers like Centene and Melita Healthcare are also getting slammed. So this isn't just a United Health problem, it's an industry-wide crisis. So what in the world is going on here? Why is a company that's supposed to be a rock-solid investment suddenly looking so sick? The biggest issue, and this is where it hits home for many Americans, is soaring medical costs. United Health's main insurance business, United Healthcare, is getting hammered, especially with its Medicare Advantage plans. This is the government-subsidized program for seniors, and it's huge. The company expected medical costs for these plans to go up by about 5% this year. But guess what? They're actually jumping by about 7.5%, and they expect them to climb another 10% in 2026. Why? Well, it's a few things. People are finally getting the care they put off during the pandemic. Think hip replacements, knee surgeries, all those non-emergency procedures that got delayed are now happening, and they're expensive. Behavioral health costs are exploding, up by about 20%. That includes mental health and substance abuse treatments. And emergency room visits are way up, and doctors are billing for more tests and services during those visits than expected. Plus, there are Medicare funding cuts squeezing them even harder. It's not just their insurance side either. Their healthcare services arm, Optum, which handles everything from pharmacy benefits to doctors' clinics, is also struggling big time. The CEO of Optum, Dr. Patrick Conway, admitted their performance has not met expectations. This part of their business saw a drop in revenue, and they're saying they underestimated how, quote-unquote, risky some new members were. On top of all this financial pain, United Health is facing a barrage of other problems. Their former CEO abruptly stepped down in May, which was a huge shocker. Then came the bombshell. The Justice Department confirmed they're investigating United Health's Medicare billing practices for potential criminal and civil healthcare fraud. This is a big deal, and it adds a ton of uncertainty. And let's not forget about the murder of their United Healthcare CEO last December. This tragedy sparked a massive wave of public anger against the entire private healthcare system, with many Americans fed up with denials and high costs. United Health, being the biggest player, became a lightning rod for that frustration. It's a perfect storm, and investors are rightly freaking out. So what's the plan to turn this giant ship around? The good news is they have one. Stephen Hemsley, the former CEO who's back at the helm, is saying they're on a rigorous path to get back to being a high-performing company. He's talking about a cultural shift towards more transparency and rebuilding trust. Here's how they're planning to fix things. They're tightening their belts. Expect them to raise premiums and cut benefits in 2026. This means more out-of-pocket costs or fewer choices for many of us. They're also looking at narrowing down their networks of doctors and hospitals. Fewer options for you, potentially better prices for them. They're getting tough on audits of payments to prevent extra costs. And here's a big one. They're leaning heavily into artificial intelligence. They're using AI tools to improve patient service, help providers, and, you guessed it, save costs. They believe AI will help them deliver healthcare better and more efficiently. They're even considering pulling out of some Medicare Advantage plans entirely, which could affect hundreds of thousands of members. They might also get more conservative or even exit some state health insurance marketplaces if they can't get the rates they need. Hemsley is promising a solid but moderate earnings growth in 2026, with stronger growth coming in 2027 and beyond. They're bringing in independent experts to review their core business practices, like care management and pharmaceutical services. They expect to have the initial findings from these reviews by the end of this year. They're also still moving forward with their plan to buy Amedisys, a home health and hospice company, despite ongoing antitrust concerns from the Justice Department. This shows they're still committed to expanding their home-based care services, which they see as a crucial part of future value-based care. Now, for the big question, is it time to sell United Health, or is this a buying opportunity? The stock has been absolutely hammered, down over 50% in the last year, but some Wall Street analysts are actually staying positive, with an average price target that's much higher than where the stock is trading right now, around $379. They believe this new lower earnings outlook could be a floor, meaning the worst might be over, and they expect United Health to actually beat these new lower earnings expectations. So while United Health is facing unprecedented challenges, from runaway medical costs to government investigations and public outrage, the company's leadership is outlining a clear, albeit difficult, path forward. They're making major changes, betting on AI and restructuring their plans. Whether these moves will truly restore investor confidence and get them back on track for long-term growth is the crucial factor that will determine their fate and potentially impact healthcare for millions of Americans. Keep an eye on those cost trends and how quickly they can implement their new strategies. That's the full breakdown for you today. If you found this useful, smash that like button, subscribe to the channel for more financial insights, and hit the bell icon so you don't miss my next video. Thanks for watching, and I'll see you next time.